the most outlandish part of most Web3 term sheets is usually the valuation. If you already have given, like, let's say 70% of your company away after year 2 or 3, how motivated will you really be to see this through for the next 10 years?
Over the last couple of years, what did you think, if you look specifically at Web3 and blockchain, like, are there things in a term sheet that you've seen that were absolutely bonkers or were absolutely great, and things you kind of like, are very common that everybody should do, and it's crazy if you won't?
Yeah, I think the most outlandish part of most Web3 term sheets is usually the valuation. I mean,
true.
So there are a couple of elements that are sort of like most of the time is not even included in Web3 term sheets. So like not a lot of, especially if it's token based, right? So maybe a quick disclaimer, or just throwing some words out there. So term sheet, I don't know if everyone knows what that is, who's listening. So basically it's what you get to sign as a startup founder when you work with a venture capitalist. So it's basically the terms of the investment. And there is a lot of provisions, usually either around the economics of the deal or the control of the startup later on. And some potential side provisions that could be like in side letters or formulated into the term sheet. But basically, it's like your contract that you sign between investor and the startup. And a lot of provisions, for example, hover around like anti-dilution rights, like the kind of shares that you're getting. Like, is it preferred shares? Is it like normal shares? What happens with the distribution of liquidity when you get into an exit, right? Like then it's like the preference, for example, liquidity preparation, or like how is the board assembled? What happens in the next round? Like, do you have any like drag-along, tag-alongs, stuff like that? But I briefly had a discussion with Charlie about that earlier, so we're not going to like go crazy into detail and all of these things. What we will do, we will actually write some blog posts about it and some LinkedIn posts later on over the next couple of weeks. And anyone who's really interested in learning more about that, please just follow and digest that and consume that because it just burst the frame here to really go into the detailed metrics. But when it comes to Web3, usually the Web3 term sheets for most parts are not even that sophisticated compared to like real equity investments, right? And reason being, and sort of makes sense, especially if a token is involved. I mean, if you're talking about a token-based investment, since you have token generation events and since you have like immediate access to liquidity as soon as the token launches through DeFi or centralized exchanges, there is some aspects that you have to consider in a normal venture capital deal that just don't apply to a token-based startup. Like, example, you invest in like a pre-seed seed company, right? Like normal startup, equity-based. Which usually means that unless you can sell your shares, whatever you bought at that point, as secondaries down the path, you have to wait until that company either gets sold or goes public and is traded as a stock before you can do anything with your investment.
Yeah, you
right?
need that liquidity event. The paper turns into real utility that you can then translate to whatever it is you want to use.
Exactly. And with tokens, usually that time frame is a lot shorter because that liquidity event, if you get an early stage, that might be 5, 7, 10 years out. Now, with most token-based companies, usually the liquidity event is like 1 year out or 2 years out, which also has one of the intricacies of Web3 deals where usually you put vesting schemes and cliffs on the investors and not on the founders. Well, the founders have it too, don't get me wrong, but usually in traditional venture capital, it's like the founders are vested, right? So they you want to secure that they don't leave their company early on, that they like stay at it for the next 3 to 4 years, exactly for the reasons that we just mentioned. Whereas in Web3, usually the investors get vesting, right? Like, so you basically, your tokens are locked for the next 2 years so that you basically don't dump your investment as soon as it goes on the market. So that is one of the key differences, which coming back to your question now, there is sometimes really outlandish and extremely weird provisions that some founders try to enforce. And luckily, the investment market in Web3 also has matured quite a bit over the last couple of years. So you have a bit more experienced investors that actually call founders out on their bluffs. Yeah. And the power dynamics are a bit different, right? Because back then, like when you had a hyped up project similar to what is happening in Gen AI right now in the real world, so to speak, the valuations that were asked for were astronomically high. Like we're talking about 30 million, 50 million or more valuations at like a seed, like pre-seed sometimes, right? Without a product in the market, without any form of real traction, which is absolutely ridiculous. And people paid that price, which usually didn't end that well in the next bear market when the tokens finally unlocked, basically.
It didn't even end well in the next bull, because by then generally they were already dead, right?
Well,
or the founders ran.
All that.
All that. Actually, not even that. Like, even if your company survives and you've overvalued, like you've asked for too high a valuation and you need a follow-on round, you've just hamstrung yourself. Yeah. So let's say hype cycle, you've then got your next level of the business, which is like, okay, I've pre-seeded or seeded at a ridiculous valuation. I've then got to go back to the well because I'm a technology business and that first round of funding is to build the thing. Now I've got to sell it and actually grow it. No one's going to invest at that valuation because the amount of the company that they're getting for the value of the money that they're giving you doesn't add up. Like they're not going to make that deal. Yep. That's the biggest trap that I've seen people with value highly fall into.
100%. And like, if you're a startup founder and you want to stay at this for a couple of years, right?
Yeah.
There's two things that should matter to you. One, don't get over diluted, right? Like don't sell away too much of your company at an early stage, because if you have to stay at it for the next 5 or 10 years, just think of the psychological effect that it might have on you if you already have given, like, let's say 70% of your company away after year 2 or 3. How motivated will you really be to see this through for the next 10 years?
Exactly.
So that's one thing. But on the other end of the spectrum, exactly as you said, Charlie, like shooting for the stars early on, well, you better make damn sure that you actually can deliver and follow on that, because if you can't, if you ask for crazy high valuations at, like, let's say a pre-seed stage, it's going to be tough to keep that momentum up potentially, meaning you might be forced to like raise a down round afterwards. And that is like, it's not a death blow per se, but let's just say it doesn't have the highest appeal, right? Like it's definitely not.
It doesn't feel good.
Your narrative, right?
Yeah. It doesn't feel good. I completely agree.